All right. Hi, everyone. Welcome to today's webinar. It is Help for Small Businesses. What does a stimulus package mean to you? Thank you all for joining us today. Before we get started, I just want to introduce myself. My name is Kim Wilbur. I'm the Marketing and Communications Director for our Greater Augusta Regional Chamber of Commerce. Before we get started, let's just do some housekeeping notes. Everyone is entered on mute, so that way we minimize the background noise. This webinar is being recorded and will be posted on our website for anybody that would like it. And also, Hanson and Weeble will be allowing questions after each section, so please feel free to type in your questions when you have them in the chat feature, and we will get to as many of those as possible. All right, great. So now we're going to go ahead. I'm going to turn it over to Courtney Thompson, our President and CEO, who will be introducing our speakers.
Awesome. Thank you, Kim. Thanks everybody for being here today. We are very excited to be able to present this today with Hanson Weeble, a CPA firm. They have had several teams working on the stimulus package and all the parts of it. So we are happy to have them come today to talk about it. I'm going to introduce Matt Hale, a CPA with Hanson Weeble. He's also the board chair for GARCC. We're very thankful for him. So Matt, you can take it away and introduce your team.
All right. Well, thanks, Courtney. First off, I want to say thank you to you and Kim and Shasta and Hannah. I think you guys are doing a great job putting information together and staying relevant in these turbulent times. And I appreciate you all giving us the opportunity to talk about the legislative changes over the past little bit. Let you know a little bit about Hanson Weeble. We've been in the community over 90 years, and we've been growing as the community grows. We have about 90 employees right now. We do CPA, your typical CPA services, which is audit and tax, some small business accounting, as well as advisory services. Today, we're going to be talking about the legislative changes, more specifically the CARES Act and the Families First Coronavirus Response Act. Keep in mind, this was put together by Congress in 5 days. So there's a lot of information that we need to fill the gaps on. So our four speakers who have been diving into this information, there's a lot of incomplete information out there. So we're going to give you the best information we have today. Along with that, the resource, the handout that we gave you guys has a link to our website. And we're trying to keep this as updated as possible for the ever-evolving changes that are occurring. We want this to be your main resource as you go through. So if we say something, you say, hey, what happened with the CARES Act for not-for-profits? Well, you can come down to the article, which should be updated to the most recent stuff we have. So we appreciate the questions you guys gave us beforehand. We've incorporated a lot of those into our presentation already. Use the chat function if there's something you want to know right away. As Kim said, we're going to try to hit that after each section. We are going to try to keep it moving. We've allowed for about an hour and a half for this to address all of the questions coming through. If we don't get to all those questions, feel free to reach back out to Kim or Courtney or shoot me an email, and we'll do the best we can to answer whatever questions you have. So to tell you a little bit, Kim Martin, she's going to be going over our first section, which is the Families First Coronavirus Response Act, the FFCRA. She's our Human Resources Administrator. She's conferred with a lot of her peers and a lot of our groups to make sure she understands it. And with that, Kim, I'm going to give it to you.
Thanks, Matt. I'd like to thank everybody for joining us today. There's a lot of information and is changing, so we'll share what we know up to the minute. So the Families First Coronavirus Response Act, which is commonly known as FFCRA, applies to all businesses with 500 or less employees, and that includes nonprofits. It includes any employer that's 500 or less. There are 6 reasons that the leave can be paid, and they're pretty specific. So it's important to make sure your employees are giving you proper documentation and that the reasons correlate with the reasons that are allowed to be paid out under the Act. I would recommend you set up separate payroll codes just to make sure you can track this all accurately and make sure that you have absolutely proper documentation for taking off and how you are coming to the wage component to be paid out. So of the 6 reasons to be paid, the first three apply to the employee themselves, and it's very specifically tied to COVID-19. If the employee is subject to a self-quarantine or has showing symptoms or is experiencing symptoms, that all qualifies as long as they have something from a professional, a medical professional, telling them that they need to quarantine, they need to self-isolate. Something important, if there's a federal, state, or local quarantine, we need to make sure that the employer is open, because the employer has to have work to do for the employee to be able to qualify. So if the employer doesn't have work because of the nature of their business and they are in a shelter in place or a quarantine, then it doesn't apply because there's no work to be done. So if that is the case for those first three reasons, the employee is eligible for 80 hours of emergency sick pay. This is in addition to any pay, any sick pay or whatever kind of policy you have at your particular company. For the first three reasons alone, the employee has to take off the 80 hours consecutively because of the quarantine is based on a 14-day quarantine. So they're not going to be off for 3 days, coming back to work and then going off again. So once they're out for that entire time. The act went into effect on April 1st. So if you have somebody who is out and sick, they can, and it was for qualified reasons, they've got documentation, it was due to COVID-19, you could pay them from April 1st until the end of their quarantine based on the guidelines. It's also important to know that it's one 80-hour bucket. Once the 80 hours is gone, either for caring for yourself if you have been diagnosed, or the next three reasons we'll touch on briefly, for someone else or a child, it's one set of 80 hours. Once the time is gone, it's gone, it can't be refilled. So the employee, if they're going to be paid, it's 80 hours at their regular wages or minimum wage, which would apply to like restaurant workers who typically don't have a minimum wage that meets the $7.25. It is 80 hours up to a limit of $511 per day for $5,110 for the entire 2 weeks. That's the maximum that can be paid out. For the next three reasons, they are all to do with taking care of somebody else. If you need to take care of a family member or someone that the Department of Labor has qualified as someone close to you that needs care, that would qualify. It has to be someone in your family, someone that makes sense, your roommate. It can't be the neighbor down the street just because they need someone to help them, unfortunately. Or you need to care for your child under the age of 18 whose school or place of care is closed. And they've since added, I'm glad to see, if you have a child over the age of 18 that either has mental or physical impairments and can't care for themselves. And they've added a little kicker to this a couple days ago that if there's more than one adult in the home, it needs to be reasonable that one of you're not able to care for them. So it's a little bit of a tricky conversation. My opinion is you sort of err on the side of let's try to work together and make this happen, as opposed to trying to get into the weeds. And then the last reason is if there's another illness or something comes up that they have designated. The interesting thing is they have not come up with what that might be yet. So basically it's a position in case there's a byproduct of the COVID-19 and it needs to be covered. For those last set of three reasons, you are paid at 2/3 of your salary, up to a maximum of $200 per day. And that would be a maximum of $10,000 for the 80 hours. Remember, it's one or all. So once the 80 hours is gone, if it's either for the individual or for caring somebody else, once it's gone, it's gone. That's kind of what ties into the whole thing. There's an additional piece if you have the child at home that needs care and you cannot work, you can't telework, you have to be available to care for that child. There is an additional emergency, which they call it emergency or expanded FMLA. That's an additional 10 weeks at 2/3 of the salary, 2/3 of the hourly wage, up to $200 a day. So the important thing to go with that is that expanded leave or taking care of the child can be intermittent if it's agreed to by the employer. So you need to they're strongly encouraging, DOL is strongly encouraging everybody to play nice, come up with a way to make this work. There could be work 2 hours in the morning, take 2 hours off, come back on 2 hours. As long as it's agreed upon schedule, it's acceptable by everybody, then it's okay. If it is an in-house working, meaning the cannot work remotely and you have to be in the place of business, has to be taken in full day increments. So you can't work a half day and then take a half day off. So it has to be you're in the office for, I don't know, maybe Monday, Tuesday, Wednesday, and you take off Thursday and Friday. With all of these, the employers cannot deny anybody at their company from taking the emergency sick leave if they in fact qualify and have the documentation. There is a caveat for the expanded family leave that if the employer has less than 50 employees and it will jeopardize the business, whether it could cause it to fail, they could deny it. Again, the DOL is encouraging everybody to work together and come up with a solution. Another quirk with the expanded leave is that you only get 12 weeks of family medical leave in whatever your 12-month window is, either a rolling year or a calendar year. It's the same for the expanded leave. It's a combination of both, cannot be more than 12 weeks. So for instance, if you had someone come back from maternity leave, they took time off for having a baby, they can't take another 12 weeks for the expanded leave. It's the 12 weeks and done, which is a little bit of a trick. 50 employers and less, you still have to hold their job position. If you have fewer than 25 employees, you're not required to hold that position. It's a couple things to just to reiterate we've already talked about, but it's really important to have separate pay codes so that it's not confusing later to keep track of everything. And it's also really important to make sure that you have all the proper documentation. All of the money you pay out under either the sick leave or the expanded family leave is reimbursable basically immediately. So if you take it out of your federal taxes that you submit after your payroll. So if you submit, maybe an example would be if you have $5,000 in tax liability that you submit, but you paid out $1,000 under the FFCRA, you could withhold that $1,000 and only submit the $4,000 in your tax liability. If you pay out more than your tax liability for that pay period, you can submit a Form 7200 to get reimbursed for that difference. The IRS is promising they're reimbursing that within 2 weeks. I don't know how accurate that may or may not be. There is a notice that needs to be posted. If you still are open for business and have anybody in your building, it needs to be posted in the usual spot with all of your other federal and state notices. If everybody is remote, you can send it out by email or put it in your company intranet or anything like that, just to make sure that it's there and available. So the big takeaways from this is it really needs to be specifically tied to COVID-19. It can't be, I'm afraid I'm going to get sick, I don't want to work, I don't feel good, I can't work. It has to be a diagnosis or authorization to self-quarantine by a medical professional. The poster was supposed to be posted by yesterday, so you need to make sure you get that out if you haven't done so already. And the DOL was originally giving the month of April to make sure that we were complying. They changed that to end on April 17th because they went from the 30 days of when the act was signed into law. So you've got a little bit of a window to make sure that you're crossing your T's and dotting your I's and doing everything properly. And if not, they're giving you that little bit of window to figure it out. I strongly recommend that everybody go to the DOL website. They've got first of all, you can get your notice there that you have to post, but they also have a very long list that they're updating regularly of questions and answers as things come up that they're trying to address. Like Matt said, they put this together very, very quickly, and there's little caveats that are catching everybody left and right. So it's a great help for people. It's great for employees and it's great for employers to help each other out. And on the Hanson Weeble site at the bottom of the article, you can find the link to the DOL information. So if anybody has any questions, I'm happy to help. It's a little bit confusing, but as long as you are making sure that everything is COVID-19 related, you'll be in pretty good shape.
All right. Thanks, Kim.
Sure, my pleasure.
Hey, Kim, other Kim, do we have any questions in the chat that you see coming through?
No, no questions as of yet.
All right. Well, Kim Martin, I appreciate your help with that. Thanks for looking into that and letting everyone know. Next section we're going to go through is the stimulus package item 2. Larry Martin is going to be leading that. He's a consultant in our tax department. He's been with Hanson Weeble for over 47 years. He's got a wealth of tax knowledge. And if there's a transaction that's happened, he's probably done it. So he's going to let us know a little bit more about how the CARES Act impacts individuals.
Thank you, Matt. So the title of this is Small Business, and what I'm going to talk about is primarily some of the individual tax provisions of the CARES Act, but all small business owners are generally individuals, so I think it's clearly applicable to all of us. As we've said earlier, the Coronavirus Aid, Relief, Economic Security Act, or CARES Act, was passed into law just 13 days ago. And as Matt said, the Congress put it together in a 4 or 5 day stretch. President Trump signed it that afternoon, and we've been trying to digest some of the, or all of the 880 pages, 880, yes, you heard me right, pages of legislation, and it's clearly a moving target. Some of the provisions and how they're to be implemented have literally changed by the hour as we've gone through this. So we're bringing you what we know, and I think it's beginning to sort out. But the whole purpose of it is to get money into the economy to help offset some of the economic, the negative economic impact of the coronavirus. So let me dive into the individual provisions. And one of the most significant parts of that is the individual rebates. But to start with that, so the gist of it is that each individual taxpayer will get $1,200 as a rebate from the government. So a couple would get $2,400. And in addition to the $1,200 apiece, for each child that is aged 17 and under at the end of 2020, so this does get measured this year, you will get another $500. So if we have a couple with 2 children that are 12 and 10 years old, they will get a total of $3,400 in a rebate. There is no action required on the part of taxpayers to get this. And this is something that we are hitting very hard, is don't let a scammer call you, contact you, email you, phone you, and say, oh, I need your social security number and your birth date or some other information in order to get your rebate. Because most likely if you give that to them, they will end up with your rebate. So again, no actions required for this to happen. A question has been raised about, suppose I am on Social Security and last year I didn't have to file a tax return, will I still get my rebate? And the IRS first said, no, you had to file some type of return, and then they quickly retracted that, and they're using records from the Social Security Administration. So basically, if you filed a tax return for 2018 or have already filed your 2019 return, or alternatively, you're collecting Social Security, you're automatically on their list and your rebate should be in process. 2 methods of how you are going to get this money. If you, in filing your tax returns, gave them bank account information, either for them to send you a refund earlier or to actually make a payment. But in any event, where you have your bank account information as part of your tax return, the IRS will immediately directly deposit that money into your bank. They were directed to have this out. Treasury Secretary Mnuchin said within 3 weeks. There's been some rumors that it could be as early as late this week or early next week, which would be 2.5 weeks. We don't know exactly when these are coming out, but they should be forthcoming fairly quickly. What happens if I do not have banking information on file with the IRS is you will get a paper check mailed to the last known address where you filed a tax return. And those, our expectation is, will probably be a number of weeks, maybe a month or 6 weeks. Getting the paper checks out is evidently a much longer drawn out process for them. So again, if you have direct deposit information, this money could show up as early as potentially next week. As part of that process, the IRS is going to send out by U.S. mail a mailing to each taxpayer supposedly within 15 days after their rebate is either posted to their bank account or their rebate check is mailed, and simply to confirm that they have sent you the money and how much they sent you. If it is correct, it's our understanding that there'll be no action required. If on the other hand, you get your letter and you didn't get your money, there will be contact information for you to respond back to the IRS and say, I didn't get my rebate. You said I did, but I didn't. And then they'll work through that. So either a bad bank account or misdirected by the post office or whatever. So at the end of the day, the IRS will not contact anybody by email. The IRS will not phone anybody. You should get your money directly without having to take any particular action or any action. And if you'll get a confirmation at the end that you in fact did get the money. So let me spend just a minute on, who is going to get this and who is not going to get this. For a single individual, there's an income threshold of $75,000, and this is based off of your adjusted gross income on your tax return. And this will actually be reconciled. This will come up a year from now when you get ready to file your 2020 income tax return. You will have to, in effect, reconcile, and whether you were eligible or not will be based on your 2020 income. So even though they're using 2018, 2019 as a starting place, you will actually reconcile whether you got the right of payment, whether you had children, didn't have children, et cetera, on your income tax return for 2020. And one of the absolute rules in here is if you got money based off of your 2018 or 2019 return, and then for some reason your 2020 income goes up where you no longer qualified, you do not have to pay it back. So if you got the money and you weren't entitled to it based on your 2020 tax return, you will not have to pay it back. Conversely, if you had too high of income and didn't actually get your rebate check because you were over the income threshold, $75,000 for individuals, $150,000 for couples, and that phases out up to about $99,000 or $198,000 for couples. If your income was too high on your 2018 return, and you didn't get your rebate, and then your income is down significantly in 2020, you will get this as a credit on your 2020 tax return. So basically it's a one-way street that if you didn't qualify before, but you now qualify in 2020, you will get the money credited to your 2020 tax return. If on the other hand, you got the money and you no longer qualify, you will not have to pay it back. Some people who won't get the money is if somebody is a dependent of another or eligible to be a dependent of another, they will not get a rebate. Again, your minor child who is under age 17 would get $500, but it goes to the parents. But if you child that's 17 or 18 and a dependent of their parents will not get this rebate. Somebody who is not in the tax system, if somebody's here and as an alien working here, but is not here legally and has not filed a tax return, they will not get a rebate. So basically it's aimed at taxpayers who have been filing tax returns.
Hey, Larry, before you move on real quick, there's a question talking about, so there's a question. So just to clarify, no rebate for college age children who are full-time students.
If they were eligible to be, if they're being supported by their parents and they're eligible to be a dependent of another, then they would not get a rebate. Now, if they worked and, if they were not dependents of another, where they were furnishing more than half of their own support and filing their own tax returns, just the fact that they happen to be in college wouldn't prohibit them, but they'd have to be filing a tax return themselves and claiming themselves as a dependent to be eligible.
Okay, thank you.
And then Larry, we do have one other question. Are the stimulus checks payments taxable?
The stimulus payment checks are not taxable. So whatever you pick up in income, whatever you get, you do not have to pick up in income. So they're non-taxable. Okay. So let's move to one of the next features of what they did for individuals. And as many of you are familiar with, if you have a individual retirement account or a retirement account with your employer, and you're age 72 or older in age 2020, you have to take a required minimum distribution. And many of you will remember the age 70 and a half that was changed from age 70 and a half to age 72 during 2019 as part of what was called the Secure Act. So for whatever reason that you had to take a required minimum distribution, Congress decided as part of the CARES Act that you would not have to take your required minimum distribution for 2020. Their idea behind this was that if the stock market were really beat up, which it has been, although it's recovering some, that you wouldn't have to liquidate and take funds out of your retirement account in 2020 to meet these RMD rules. So the required minimum distribution rules are waived for 2020. So this, if you're age 72 and didn't have to do it, or if you had perchance an inherited IRA where you had inherited an IRA from somebody else and you're age 30 or 40 or whatever, you do not have to take your required minimum distribution there either. So again, all these are one question that has been raised. Suppose earlier before this came about, I had taken my required minimum distribution. There doesn't seem to be a clear answer to that quite yet. If you took it in the last 60 days, you could actually put it back into the IRA or into the retirement plan as you could with any distribution. If it was more than 60 days ago, say you took it in January, there doesn't seem to be a clear answer to that, although I think a lot of people have asked Treasury to waive that distribution rule and let them put it back. So if you haven't taken it, you don't have to take it. Now, the flip side of this is you're perfectly eligible to go take any retirement distribution that you want to. All this says is you don't have to. You don't have to have the required minimum distribution. But if you need money, want money, or just routinely take money out of your retirement account or your IRA, then do so. There's no prohibition on that. Okay. One of the next things they put into the CARES Act is that for persons who are making charitable contributions but are no longer itemizing the deductions, and as you'll recall, there's $24,000 standard deductions now, and so a lot of people are not itemizing deductions anymore, and therefore they got no tax benefit for their charitable contributions. The CARES Act provides a $300, what we call above the line. So in other words, before you get to adjusted gross income, if you made a charitable contribution to a qualifying organization during 2020, you can deduct up to $300 of that before you get to your adjusted gross income, even though you're still taking your standard deduction for 2020. So this was, again, an incentive to try to make that better. One of the other things that they changed for 2020, and I don't think it impacts very many people, but as most of us know, charitable contribution deductions are limited to 50% of your adjusted gross income. And for 2020, charitable contributions, if you made a large charitable contribution and then, for example, were running a business and incurred a loss and your adjusted gross income went down, that where your AGI was fairly low for the year. For 2020, the charitable contribution limitation has been raised to 100% of your AGI. And that there's a few restrictions on that. So if you're getting ready to do that, check with us and we'll tell you, because there's a couple of charities and donor advised funds and things that you can't do that on. But if you're getting ready to do that, let us know. So, the next provision that they put in there was student loan repayments. And as many of us as small business owners know, we have been able to, in recent years, provide education to our employees through payment of tuition, payment of other educational expenses for them, and take a deduction for it as a business person, but they did not have to pick it up in income to the amount of $5,250. What changed this year is if one of your employees had a student loan, not current tuition, but a student loan, you'll be able to actually make that loan payment on behalf of your employee. You can make their student loan payments up to $5,250 anytime during 2020, and that will still be excludable from their income. Normally, if you're making student loans payments for them rather than direct tuition, it would have been taxable. But for this year, to help out an employee, you're helping, you actually make some student loan payments directly for them. You still get a deduction. They do not have to pick it up in income. And one of the last features that the CARES Act affects individuals is for those persons who are 59 and under, 59 and a half, under 59 and a half, if you take money out of a retirement account or out of your individual retirement account, your IRA, not only did you have to pay tax on it, you had to pay a 10% penalty to the government for that, what was called a premature distribution. That 10% premature distribution penalty has been waived for withdrawals from IRAs or from retirement accounts by persons under age 59 and a half for any time during 2020, up to the amount of $100,000. So if you need to go, somebody needs to do that. Now, what the more important part of that is, there's an additional feature to that. While that normally would be ordinary income, like any pension distribution, there's a provision in here that says not only is the penalty waived, but if you are in a position to put that money back into the retirement account or the individual retirement account during the next 3 years, then you can put the money back and never have to pay tax on it. Alternatively, if you say, I'm not in a position to put it back, but I don't want to pay tax on all of it in 2020, the other alternative is that it can be includable in your taxable income during 2020, 2021, and 2022. So even though you get all the money this year, you won't actually pay tax on it until over the 3 years. So, and one last point that is really under the individual, it's not part of the CARES Act, but I think probably everybody in the audience is already aware of this, is the IRS or the Treasury Department has delayed the filing and payment of individual income taxes from April 15th to July 15th. So if you had a balance due, you get until July 15th to file your tax return and pay that money, no penalties and no interest. There's some other nuances of, will you still, for those of you who pay estimate payments, looks like right now you're still going to have to pay your June 15th payments, and there's some other things, but be aware that the filing date has been extended. One important point about that is the state of Virginia returns are due May 1st, and they have not at this point changed that. We do not foresee that they will change that. They have extended the payment date out for a month, but you still either have to extend your Virginia return by May 1st, or you have to actually file your return, even though your federal return's not due. So that's a trap out there. So make sure you don't look at the July 15th date and just say, I don't have to worry about filing an income tax return. So,
Larry, we do have one question. Is it safe to assume that the charitable IRA rollover is still possible for individuals age 72 and over in 2020?
I'm not sure I understand I'm not sure I follow the question.
Yeah, the QCD.
Oh, the QCD, yes. I'm sorry. Yeah, okay. For the charitable contributions, what we call qualified charitable distribution, a QCD out of an IRA, absolutely. So, even though you don't have to take your required minimum distribution, clearly you can have your IRA transfer money directly to a charity, just as you did. It's just that you don't have to do it to meet your your RMD requirements.
Well, great. Thanks, Larry. I really appreciate it. It was a lot of good information. We'll move on to the next item. I'm sure a lot of you guys are eagerly awaiting the PPP and EIDL loans. Chris Brubaker, he's a partner in our tax department. He's been a CPA for over 20 years. He specializes in a lot of areas. Taxation is one, business valuation is another, as well as business consulting and advising. He's really a good resource for our clients, and we're glad to have him here. So he's going to be going over the CARES Act, PPP, Paycheck Protection Program, and the EIDL.
Great, thanks, Matt. So like Matt said, a couple of SBA loan programs were affected by the CARES Act. The economic injury disaster loan, I'll just go over that briefly because it's not been as big an issue, understandably so, compared to the Paycheck Protection Program. The EIDL was, it's a program that's been around for a while, I think, under the SBA. All the CARES Act really did was change it simplified some of the application procedures, and reduced some of the personal guarantee and collateral requirements that are typically under the EIDL program. The program basically allows businesses that operate in a disaster area that have been affected by a disaster to borrow money directly from the SBA. As of now, everywhere in the United States has been declared a disaster, so it should qualify for really any business that meets the SBA's size requirements. We're going to kind of base this talk on a chart we put together that compares and gives some information for both the EIDL and the PPP. And we've got more detail there for the EIDL if it's something that does interest you. As I said, I don't think I've seen a client apply for that yet. And really most of our focus has been on the PPP. So that's where we'll focus most of our talk today. The PPP, as I think you probably have heard of by now, it's one of the bigger parts of the CARES Act that is going to help small businesses. We put together a chart to kind of lay out some of the details at a fairly high level. I think maybe the best approach would be to walk our way down the chart and kind of talk through the basics of the program just briefly. Now we did this early on, so it's based on what the Act itself says. We've had some subsequent guidance from the Treasury Department and SBA that either clarifies or in some case contradicts the Act, but those are what the rules are now. And so I will note there are a couple of things that have changed that we'll update in the chart. So the purpose of the PPP is really to help businesses maintain their payroll, that's number of employees, as well as their compensation levels while they're dealing with the virus outbreak. The eligibility, it's for small businesses, so that's generally 500 or fewer employees. Now there's some exceptions to that for franchises, for businesses that are involved in hospitality, but 500 is a good kind of rule of thumb as for whether a business can qualify for a PPP loan. It applies not only to businesses, but also to 501c3 nonprofit organizations and 501c19 organizations, which we didn't list here. Those are our veterans organizations. It can also benefit self-employed individuals and sole proprietors. So the gist of the loan, it provides up to $250% rather, of a business's monthly payroll cost for the previous year. And that's capped at $10 million for a business. The interest rate, this is from the Act, it was a maximum of 4%. That's actually been reduced down. I mean, the actual interest rate will be a fixed 1% interest rate under guidance we've got from SBA and Treasury subsequent to the act being enacted. The repayment term changed as well. So the act has an up to 10-year repayment term. That is now 2 years as a fixed repayment term under these loans. And then the deferral period, which that just means the time when you have to start making repayments on these loans. That is a fixed 6 months now, and that is 6 months from the date when when the borrower receives loan funds first. Okay. Just a couple of more details about the loan itself. I mean, there's no personal guarantee required, which that differentiates it from other SBA loans, as well as there's no collateral required. So it's an unsecured loan. And again, that's different from the normal SBA rules. The act says that the loan proceeds have to be used for either payroll costs, for mortgage payments, for rent payments, or for utility payments. Some of the subsequent guidance from SBA added a restriction that at least 75% of the loan proceeds need to go toward payroll costs. So that leaves you 25% for the other purposes, for facilities costs and utility payments. Okay. Banks are are administering this program for the SBA, and so a potential lender would fill out an application, would go to a bank and apply, and provide, the evidence to support the payroll costs, because that's really what everything is based on up front for the loan. And then the banks themselves go through what needs to happen between the bank and the SBA to get the loan approved. We have seen just a few approvals trickle in. I think I saw the first one yesterday where a bank sent out loan documents that had been approved. So I think the banks have been bombarded with these since, I guess, over the past week. And so it's kind of a slow process getting those moving, but we are starting to see people have loans approved, and hopefully we'll see cash start to flow out to businesses hopefully soon. Yeah. So again, that's just kind of a brief overview of the process itself. There's kind of two aspects here. There's the loan, and then the part down here below, the forgiveness piece, is really what's unique to this. So it can really become more of a grant than a loan. And kind of a caveat before we start on looking at forgiveness, there's not much guidance there yet at all on this piece of it. What we have says that the SBA will provide guidelines for loan forgiveness. They're supposed to do that within 30 days of when the act was signed into law. So that means this month, essentially. We'll have something from SBA about what the application for forgiveness looks like and what some of the details that we still have open will look like. So I will talk about forgiveness to the extent we know just based on the act. But again, as we saw from the way the act looked from the loan side to what it looks like when we come down to actual applications, that changed a lot. So I can guarantee not much, but I will guarantee that things will change from what I tell you about loan forgiveness today. Okay, so basically forgiveness is based on, there's an 8-week covered period. And that period starts when the loan is first dispersed to a borrower. Okay, and during that period, again, the borrower has to use the loan funds for those purposes we talked about above. And again, that was 3/4 of the loan used for payroll cost, and then 25% can be used for either mortgage payments, lease payments, or utility payments. In a nutshell, if a borrower does that and uses all the loan funds for those purposes, the loan will be forgiven. Now, nothing with this act is that simple. So there are provisions where the repayment or the forgiveness can be reduced. Now, the repayment, that reduction happens if the business has either a reduction in its headcount, in other words, in the number of its employees during that 8-week measurement period, or if it reduces employees' wages during that period. Okay. The first test for the headline count, that is based on, you're looking at the number of full-time employees. And again, that's a term we don't know exactly what that means yet. I don't know if full-time employees means based on a 40-hour week, based on a 30-hour week, or really what yet. So hopefully that'll be something that comes out shortly from the SBA that will help us out on that. But you look at the number of full-time employees that the company had during those 8 weeks and compare that to one of two periods from prior. And so those periods are either February 15th of 2019 through June 30th of 2019, or January 1st of 2020 through February 29th of 2020. And the borrower gets to choose whichever one of those is more beneficial in making that comparison. The second test is a wage test, and this is based on each individual employee. And I should have mentioned up above that when we look at employees, we're really talking about employees who make less than $100,000. You can reduce wages for someone who makes more than $100,000, and it won't affect this test. But for all your employees who make less than $100,000, you have to look at each employee's wages during that 8-week test period. And if their wages are reduced by more than 25% compared to the period from from the quarter immediately before the test period, then you have to reduce your loan forgiveness by that amount. Okay, and again, just reading the law, to me there are some questions there as well. There's not a ton of guidance about kind of how you measure that. So is it monthly average wages, like a lot of things in the law are written as monthly averages, or is it hourly, or it's things we don't know yet, and I think we'll be waiting on guidance from the SBA to tell us more about that. To complicate things a little more, I mean, actually this complicates things on the better side. There's a correction period, and so that goes up until 30 days after the act was signed, which means April 26th. If you see that you've had to lay off people, or you've had to reduce wages, but you still want to be able to benefit from this forgiveness, if you hire people back or if you increase your wages, then you don't have to count whatever reduction happened in that period that ends April 26th. So in other words, you can look at April 26th forward as being your measurement period rather than the 8-week period, as long as you restore your head count and your wages by that time. So I know that's all absolutely as clear as mud. Other things we don't quite know yet, we don't know the application process for forgiveness. We do know that borrowers will have to apply for that with their lenders. They'll have to provide support of what their head count and their wages were during the 8-week period, and presumably would need to have similar information for the measurement period before to be able to compare whether there was a reduction or not. Again, we don't know what that's going to look like. Lenders are supposed to have 60 days once they receive the application for forgiveness to make a ruling on that, to let the borrowers know how much of the loan has been forgiven. And so if you kind of look at how these dates pile up, the borrower has its 8-week period, and I would think you will get through that before you can apply for forgiveness. And then there's 2 months essentially after that when the lender has to let the borrower know about a forgiveness amount. So those all fall within that 6-month deferral period before payments have to actually start being made. So hopefully before the deferral period ends, borrowers ought to know how much of the loan they're actually going to have to repay. Okay, so that's kind of what we know as far as forgiveness goes right now. A couple of just general things. As of this morning, there was a Senate bill. The CARES Act initially set aside $349 billion for the PPP program. That's being used up either quickly, or some people have said it may be gone by now. I don't think we know really fully well how many applications and for how much money there have been yet. There's a bill in Senate as of this morning to add another $251 billion to bring the total program up to $600 billion, just so you don't run out of funds on that, which is really, it's fair when you think about under the application process, self-employed and sole proprietors and independent contractors, we're not supposed to begin applying for the loan until tomorrow. And so, you know, if the money's gone for them, that really is a bad result. And so, you know, we expect there will be more funding at some point for this. We just don't know when and how much. And again, that just kind of goes toward more of the unknowns that we have. So I think there were a few questions we had chatted in and some from before, so I'll try to answer those as best I can.
Yeah, Chris, I think you answered some of these as we come through. The first one, let's say payments start in 6 months to a year. When does it turn into grant and forgiveness? I think you talked a little bit about that. I mean, it's still being determined a little bit.
Yeah, and the forgiveness ought to be before that 6 months. And so you really should never get to a point where you're paying on a loan and then it becomes a grant after you're already making payments. You ought to know the grant amount versus the loan amount before that 6 month deferral period when loan payments have to start.
So, and then the next question, and I think this gets into a little bit of your correction type period, but if an employee who leaves, either they quit or they were fired for cause, and you replace them with a new employee, as long as the head count is the same and hasn't reduced.
Yeah, I think the head count piece of that would be satisfied if you hire back a replacement. Where we'll need more guidance too, like I said, is on how the salary piece of that works. You could read the language in the act as saying that if you have an employee who's, you know, essentially if you do that, if the employee is terminated or if he leaves before that 8-week period begins, I think as I would read the act, you don't count him at all because, you know, he wouldn't have had a reduction during that period. But again, that's my interpretation on April 9th at noon or whatever we are right now. So that could very well change once SBA gives us guidance.
And that's really the talking point is SBA needs to give guidance so we have concrete
That's right.
direction here.
That's right.
So, and then the next part from Beth Brown. So if I understand this correctly, the business needs to be paying employees while closed for this portion to be forgiven, or at least the 8 weeks following the funds being dispersed. Correct?
Yeah, that's right. So the payment's based on your payments to employees. I think that's regardless of whether your business is open. So I think as silly as it sounds, you can end up paying people to stay home just to be able to, you know, maintain the relationship with the employee so that you're able to open back up when you're able to.
Okay. So, and that kind of goes to the next question. What if a business is still closed for all of a portion due to state or government mandates?
Mm-hmm.
I mean, it would be along the same lines.
Yeah, and again, absent any more guidance from the SBA for any kind of waivers on that, that's how I would interpret the law right now.
Yeah. And then the last question, all of my 6 employees are part-time. Am I still eligible? And I think you were saying there's no definition for what a part-time versus full-time is at this time. So
yeah, the act talks about full-time equivalents. And so, you know, I don't know if that's full-time as a percentage of 30 hours or full-time as a percentage of 40 hours or how that's calculated. But, you know, having 6 employees who are part-time does not keep you out of the act, out of the PPP at all. We'll just need more guidance as far as how you calculate how your 6 part-time employees translate into full-time equivalents.
great. Well, I think we've hit most of the questions. Chris, thank you for explaining it to us. Thank you for your time, for learning it.
Sure. And one other thing I should have mentioned, Larry had mentioned before the question about whether the rebates coming back from the IRS are taxable. In a similar vein, you know, generally loan forgiveness is a taxable event. There's a provision in the act here that this is not taxable, right? So if your loan becomes a grant, that's not taxable income. And as an added benefit, the expenses that you use the loan funds for are still tax deductible expenses. So you get the benefit on both sides there. So again, it's all to kind of help us all make our way through this tough situation we find ourselves in.
Great. Well, thank you, Chris. All right, we'll move on to the next portion, item 4, the CARES Act impact on businesses. David Harris is going to be leading this discussion. He's a supervisor in our tax department. He specializes in business and multi-state issues, He's extremely knowledgeable about the intricacies of tax law. I think he really enjoys reading it. So anyway, David, with that, I'll leave it to you.
Hey, Matt, we just had one more question that
Oh.
came in. It just says, I have employees who have their hours reduced and are collecting unemployment. Once this money is received by the business, do the employees need to stop collecting unemployment?
Yes, they would have to stop. They would have to come back to work to be able to use them for calculating the forgiveness in the program.
Thank you.
Good afternoon. I'm David Harris. I would apologize for not having video available for you, but that's probably to your benefit rather than detriment. But I'm going to talk to you a little bit about some provisions for businesses in the tax arena rather than the loan arena. And there are two main segments that we're going to talk about. Two are some new provisions that came in through the CARE Act. And then the rest of it is changes that have been made, kind of reversing some things that happened in the Tax Cuts and Jobs Act or the tax reform bill from a couple of years ago. So under the new provisions in the CARES Act, the first one is the employee retention credit. And that is to reward small businesses for keeping their employees on. And it's a refundable payroll tax credit for 50% of the wages that you pay to your employees, capped at the first $10,000. So broad strokes, if you continue to pay your company, your employees during this time, the first $10,000 that you pay them, you can get $5,000 of that back as a credit against your payroll taxes. And that is a refundable credit. So if the amount of the credit exceeds the amount of the tax that you have on your 941, then you can get it all back. Now, before we get into more of the details, one thing that is true of both this and the next program I'm going to talk about is that neither one of them is available if you have taken advantage of the PPP loans. If you have done those loans, then you are not eligible for either of these programs. It's slightly less clear whether you can participate in these programs if you plan to do a PPP loan at a later date. If you use the employee retention credit now, and then in a couple of months you decide that you're going to do the PPP loan, do you have to recapture the credit that you took? If so, does it go back to the original date? That's all very unclear right now. Our advice to clients generally is, if you are planning to apply for a PPP loan, you should not take advantage of the employee retention credit or the next program that I'm going to talk about. But if you're not going to do the PPP loan for whatever reason, and I think a good chunk of small businesses are going to do a PPP loan, but if you're not, if it doesn't make sense for you for some reason, these are some other programs that are available to you. So, refundable payroll credit, 50% of the first $10,000. The wages that count toward it are different depending on the size of your company. If in 2019 you had 100 or fewer average employees, then you are able to use all of your employees' payroll for purposes of calculating the credit. So it doesn't matter. You might be maintaining your same headcount for employees, and everybody's working, but you're able to use all of your employee wages to calculate this credit. If, however, you have more than 100 average employees in 2019, then you can only use the wages that are for employees who are furloughed or have reduced hours, but you're still paying them. So you can only use wages you pay the employees when they're not actually working. We talked about with the PPP loan that, if you got that loan and you had the 8-week period, measurement period, you might be ordered to be closed by the government, but you're still paying those employees so that the government is essentially paying it for you. Well, in this case, if you have more than 100 employees, only those wages you pay where the employees are not providing any service for you can be used toward calculating that credit. So obviously that creates a pretty much of a cliff situation when you go from 100 to 101 employees in 2019. But I think we're talking to a little bit smaller small business mindset today, and so that might not be relevant for you. There are some other wages that are not eligible for this, and that's basically wages you're getting reimbursed for. So anything that is eligible for the work opportunity tax credit is not eligible. and anything where you have paid sick leave or family leave under the Family First Act, which Kim talked about. So if you're paying out sick leave to an employee, but you're going to immediately turn around and take a credit and get that refunded by the government under the Family First Act, then you cannot use those wages for the employee retention credit. That just makes sense. So this applies to wages that are paid from March 13th to December 31st, 2020. I think for most of us, you'll reach that 10,000 long before the end of the year for many of your employees. Payments can include, if you have employees who are making less than that 10,000 and you're paying for a health plan for those employees, those payments can be included with their wages in getting you up to that $10,000 cap. So you pay an employee $6,000 in salary and you pay them $4,000 in for health benefits, then you can use the whole $10,000 for that employee for calculating the credit. If you are planning to take advantage of this program and you withhold paying your payroll taxes in anticipation of getting the loan, or sorry, of getting the credit, and then it turns out that you're not eligible for the credit for whatever reason, then you get some relief from penalties. You do have to pay the tax, but you get relief from penalties. And you would begin taking that credit on the second quarter 941. So you're not going to do anything for your first quarter, those of you that haven't filed it yet. You're going to start taking it for that period from March 13th to March 31st. That will happen on the second quarter 941, not the first quarter. Now, one big other caveat to this is that there's a restriction for the eligible employers that can take advantage of this. If you have been fully or partially suspended by government order, if you're a non-essential business and they've told you you have to close down, then you count. Or if you have experienced more than a 50% reduction in your quarterly receipts. So that would be comparing, let's say, first quarter 2020 to first quarter 2019. Quarter over quarter, if you've lost more than half of your revenue, then you are eligible for the program. Again, it's not eligible if you participate in the PPP program. And it does include nonprofit organizations. So that's great. Nonprofit organizations still pay payroll taxes if they have employees, and they can get this credit as well. If you have multiple businesses that share common ownership and they start looking at that in the 20% range of ownership, it wasn't clear in the act exactly which definition of aggregation they would use, or of common ownership, but you do have to take into account, if you have multiple companies, to arrive at the number of average employees, that 100 employee threshold for which wages get to count toward the credit. So that's the employee retention credit. And then we move into the second program, which is the delay of payment of the employer payroll taxes. So if you are a small business, you're paying your employees and you're not participating in the PPP loan, then you can, for the employer portion of your payroll taxes, defer payment of those for the rest of the year, starting on March 27th and through the end of the year. You can take the employer portion, not the employee FICA or Medicare, not the employee federal or state income tax withheld, but the employer FICA, the employer Medicare. You can delay payment of those. You add it all up through the end of the year, and you don't begin paying it until December 31st, 2021. And then you pay the first 50% of the deferred amount. The remaining 50% is not due until December 31st, 2022. So that's a substantial deferment. It doesn't make the tax go away, but it does give you some cash flow. If you are a self-employed individual where you're going to pay self-employment tax on your Form 1040, then you can defer payment of half of that self-employment tax. And so you can adjust your estimates accordingly for that. So when you pay self-employment tax, you're paying both the employer and employee portion of your FICA and Medicare. And so you can defer half of it. That's treated as the employer portion.
Hey, David?
Yes.
Who needs to be keeping track of this? Is this, if you use ADP or Paychex or some other payroll provider, are they going to be keeping track of these deferrals and remitting it with your tax forms on annual basis or quarterly basis? a year or 2 years down the road?
I certainly hope so. How that's going to be tracked is going to be interesting. I can only assume, I haven't seen the updated 941s, but my assumption is that there will be a line item in there where you back out the portion that you're deferring, and that will have to be kept track of. Certainly the government's going to be keeping track of it. And it will be ultimately incumbent on the business owner to keep track of that payment and when it's due in the following years. That leads me to the next point, which is if you're using a third-party payroll provider, not a payroll service, but if you're essentially leasing employees from a third party, certified professional employer organization, I believe is the term. So these companies, they hire workers, they're writing the paychecks to them, but they are leasing them to you. You pay that company a fee for those employees to work for you. You don't have the burden of dealing with the payroll issues, but you are still ultimately the employer. So if you tell the third party, hey, I want you to defer the payment of the employer payroll tax for these employees I'm leasing from you, and they do so, then when you get to 2021, you, the business owner, are responsible for making those payments, not the third party that you told to defer. Because, presumably the reason you're going to tell them to defer is because they're going to charge you less for the lease of those employees. So that is a fairly straightforward program. And again, not eligible if you're part of the payroll protection program. We've had the question come up. I'm going to be filing my first quarter 941s. Do I pay the employer tax or don't I? Well, first of all, there's only 4 days that are eligible during 2021 that could be deferred as I read it, or sorry, during 2020. So during the first quarter. So that's not a huge issue, but even so, circling back, if you're going to be doing the PPP loan, then we recommend that you do not defer these payments, that you go ahead and pay them as they're normally due. So then we get into some tax provisions that are affecting, or basically reversing some things that changed during the Tax Cuts and Jobs Act. And that is, we're going to start with the impact on net operating losses. So historically, the way net operating losses work is if I had a loss in let's say 2020, then I could carry that loss back to 2 or 3 years prior, depending on what type of loss it is, and go back and recapture some tax that I paid in those earlier years, rather than waiting until the next year when I might have future income in the future to use that loss. So I could carry back that loss, file a return that takes that loss, and then I get an immediate refund from the IRS for the tax the reduction in the tax because of the NOL. So that's the way it's worked for years. Under the Tax Cuts and Jobs Act, they eliminated the ability to carry back the loss. All losses had to be carried forward. So that's obviously a detriment in terms of getting cash in your hands. However, under the CARES Act, NOLs now can be carried back, and this applies to NOLs arising in tax years beginning after 12/31/17 and before January 1st, 2021. So essentially, 2018 through 2020, you can now take any losses generated in those years and carry them back. And not just the 2 or 3 years that you could before, they can now be carried back 5 years. So if you had a loss on your 2018 tax return and you were not able to carry it back, and let's say you didn't use any, you had losses in 2019 as well, and you didn't use any of that NOL, you can now go back and take that 2018 loss and carry it all the way back to 2013 and start recapturing tax that you paid in that year. And that's money you'll never be able to get at again. It's really a one-time opportunity to go back and capture that tax. So if you have a 2019 loss, you can carry it back as far as 2014, and you go back to that 5th previous year and then work your way forward using up the loss. Obviously, their expectation is that a lot of companies are going to have big losses in 2020. And then that will go back to 2015, where you'll begin to be able to capture the tax then and carry that loss back. But it's something to be aware of if you did have a loss in 2018, or maybe you've already done your 2019 return. you do have the ability to go back and carry that loss back now. We're waiting to see how the documentation of that is going to work because of some elections that have to be made. But, you know, our assumption is that once they get the forms fixed, we'll be able to go back and probably file amended returns for those years to carry back the loss. The other change that's been made to net operating loss is that historically, you were able to use that net operating loss, at least for regular tax purposes, to offset 100% of your taxable income. So if I had $100,000 of income in 2018, and then I have $100,000 of loss in 2020, I could carry that loss back and eliminate all of that taxable income and get all of my tax back. Under the Tax Cuts and Jobs Act, of course, this doesn't apply to carry backs, but it applies to carry forwards. For losses generated beginning in tax year 2018, you could only use those losses to offset 80% of the taxable income in the year that you carried the loss to. So if you had $100,000 loss in 2020 and a $150,000 loss, or sorry, an $80,000 income in 2021, then you could only offset 64,000 of that 80,000, and you'd still be paying tax on the 16. And the excess gets carried forward, but it's just a delay in how you can use the credit or use the loss. Under the CARES Act, that limitation is removed. So any years before January 1st, 2021, where you generate a loss, you can now, when you carry that loss back now, which we can do, or you carry it forward, you can use it to offset 100% of taxable income. Beginning in 2021, the limitation is restored for the deductibility of those losses that were generated in 2018 through 2020. So my 2020 loss, if I carry it back, it can offset all of my income in the year I carry it back to. But if I carry it to 2021, then that is going to still be subject to that limitation. So the Tax Cuts and Jobs Act only affected net operating losses that were generated in 2018. It didn't affect the deductibility of prior losses in that year. So we don't expect that anybody will be going back and amending their 2018 return to change the classification of that loss, because it only applies to a loss generated in 2018. It's possible you could be amending your 2019 return if you limited the deduction for the 2018 loss. I know this is a lot of years and a lot of carrybacks and carry forwards, but I'm just trying to illustrate the opportunity that you have to maybe get some cash right away for losses that you may have had in 19, and especially for the losses you might generate in 2020. So that's the changes to the net operating losses. There were several other limitations that were made to business deductions as part of the Tax Cuts and Jobs Act that have now been partially delayed, at least in their effectiveness. The first one is the deduction for excess business losses. Under the Tax Cuts and Jobs Act, if you were an individual and you had business income flowing through to you, any loss in excess of $250,000 was not deductible to you for tax years beginning in 2018. So, you know, the classic scenario, you've got $500,000 of investment income and you've got $500,000 loss on your winery or your farm or what have you, and then you could offset those entirely. Well, under the Tax Cuts and Jobs Act, you're limited to that $250,000. Even if it's a fully deductible, legitimate business loss, you're capped at that $250,000. Under the CARES Act, those limitations are removed for tax years 2018 through 2020. So another opportunity where if in 2018 you had a loss that was limited, and this is more as an individual, then you you can go back and amend that return and get credit for that loss. The next is the acceleration of the minimum tax credit. The corporate AMT for C corporations was repealed as part of the Tax Cuts and Jobs Act. So what that left a lot of businesses with is they had in the past paid AMT, and then in future years where their regular tax exceeded their AMT, they were going to be able to get a credit against that tax. Well, now there is no AMT to figure, so you know, they didn't want businesses to just deduct all of that credit immediately. They spread that out over 4 years, subject to some calculations. So you could take it beginning in 2018, 2019, 2020, and then whatever you hadn't taken by then, you could take in 2021. Under the CARES Act, when you file your 2019 return, you can take any remaining unused AMT credit on that return. There's also the option to elect to take the entire credit on your 2018 return. So again, if you're amending your 2018 return anyway, go ahead and take the full amount of that AMT credit if you have one. Then we have the deductibility of interest expense. There was another limitation as part of the Tax Cuts and Jobs Act that said you could only deduct business interest expense up to 30% of adjusted taxable income. And under the CARES Act, that's now limited to 50%. So if you had $100,000 of income and you paid $50,000 of business interest, well, let's say you had $50,000 of regular, taxable income, and you pay, and deducted as part of that is $50,000 of business interest. You add back that $50,000, so you have $100,000 of adjusted taxable income, and then you're limited to 30% of that, which would have been $30,000. So you just lost $20,000 of deductions. Under the CARES Act, you can get up to 50% of your adjusted taxable income for a deduction for business interest. That does not go back to 2018. That only applies to 2019 and 2020 for calendar year taxpayers. There are some special rules for partnerships. So if you're a partnership that encountered that limitation, you can take whatever you are not allowed to deduct in, whatever you're not allowed to deduct on your 2019 return, half of it will be deductible in 2020 with no limitation, and the rest is suspended under the regular rules. You can elect out of the increase in the deduction if you want to, but I don't know why anybody would. And then there is also an interesting election, because so many businesses will be expected to have losses in 2020 and might be expected to have some substantial interest expense on loans that they take out to keep the business afloat. You have the option to calculate your adjusted taxable income for purposes of your 2020 interest deduction using your 2019 adjusted taxable income. So if you made $100,000 in 2019 and you had a loss in 2020, you could still deduct half of your 2019 income as interest expense in 2020. So again, no impact there on the 2018 returns, but it could have some impact on 2019.
Hey,
so
David.
The final thing that may or may not apply to many of you, there was an error made in the drafting of the Tax Cuts and Jobs Act. And it was something that people noticed pretty quickly, but Congress being Congress, it has not gotten fixed since then. And that was the definition of qualified improvement property. We used to have a thing called qualified leasehold improvements and qualified restaurant property and a couple other things that were subject to a 15-year depreciable life. And then because of that, they were eligible for bonus depreciation and possibly Section 179. As part of the drafting of this, where we had the 100% bonus depreciation come into play, and where we have the definition of qualified improvement property as a new category, they accidentally left that as 39-year property, which is what normal non-residential real estate would be. The designation as 39-year property meant that it was no longer eligible for bonus depreciation. So it was, in fact, eligible for Section 179, but there are some limitations on Section 179, such as if you put more than, I believe it's 2.5 million of 179 eligible property into service in the prior year, then you couldn't take any Section 179 deduction. Or perhaps you had a taxable income limitation that you were bumping up against. It's in some ways better to take Section 179, at least as a Virginia company, because Virginia recognizes the full amount of the federal Section 179 deduction. Virginia does not recognize bonus depreciation. So if you decide to go back and say, and again, this applies to property placed in service after 12/31/17, so beginning with your 2018 tax year, now that that's 15-year property, maybe you go back and change how you deducted it. Maybe you took 179 before and now you're going to take bonus for some reason, or you didn't take 179 because you weren't eligible, and now you can get that deduction. Just be aware that's going to be a deduction for federal, but not for Virginia. That will be an add back on the Virginia return.
Yeah, and if their CPAs are keeping track of this, hopefully whoever their service provider doing their tax return, they'll have that and be able to give them a little bit more guidance on that.
Absolutely.
So,
I mean, with all of these, you're going to want to go back, be aware of the broad strokes of this, but go back to your provider and say, is there a chance, number one, is there anything I need to do on my 2019 returns that they're working on now? And then maybe is there something I need to do on 2018 where I could get the opportunity to generate some losses that then I can carry back and get some cash in my pocket? Because at this point, everything that they're doing is about putting cash in businesses' pockets so they can stay afloat. Until we get through this situation.
And
So
we have
there
one
are a
question.
couple- Go ahead.
We have one question here from Jeff going to the end, and I'm not sure, I think this can apply to a lot of different people here, David. I'm not sure if this is you or Larry, if you're on, or Kim, if you all can address it. Yeah, I have the questions from Jeff. I have 50 employee, employer, or less waiver. What is required for us here? He has half a dozen employees foaming at the mouth to sit home and collect more money with the stimulus money and unemployment. And I think that was an unintended consequence of some of this legislation that came through. But I don't know, Larry or Kim, if you go want to.
Yeah, I think that's true, Matt. I think that the government, because you get state unemployment, which in Virginia can be up to almost $400 a week, and then $600 per week from the feds. Clearly there are some employees who are going to make more money sitting at home than they are working. And I think this was an unintended consequence. Remember that the employee has to be laid off to do that. They cannot quit and collect that unemployment. So, if you need your employees, even though you're possibly paying them less than they collect on unemployment, they need to be there and work. And particularly for the payroll protection loan, the program, the PPP program, they need to be there so you can spend the money and they get the money from the government that way. So
Yeah, hopefully give them a longer term view than the next little bit, but maybe 6 months down the road when you need a job. So next item we're going to move on to is the CARES Act impact on not-for-profits. I think we summarized a lot of this information, and Larry knows a lot about a lot of stuff. So we're going to have him recap some of this and let people know what's available. So
thanks, Matt. And as Matt said, there's really not anything particularly unique to not-for-profits. The primary focus is that the PPP loans, the payroll protection program loans that Chris talked about, those are available to 501c3 not-for-profits. So again, the charitable nonprofits are eligible if they have less than 500 employees, which most nonprofits do. Nonprofit business leagues and social clubs and other organizations are not eligible for the PPP loan. It's really only the C3s. So again, refer back to what Chris said, and they can do that. And they have the loan forgiveness, so it can be a grant for them as well. And a lot of them are getting hit. So I think that's the first thing for it. The other two things that the CARES Act does that benefits nonprofits is that as fundraisers, people, and this is back under the individual section, can deduct $300 of charitable contributions, even though they still use the standard deduction and don't itemize deduction. So that's a sweetener that nonprofits can do. And additionally, if you've got a large contributor and a big campaign or something like that, and that person also had this reduction in their adjusted gross income, they would have this 100% of AGI limit in 2020. So I think it's really not a whole lot unique to nonprofits other than the payroll protection loans. It's our understanding from at least one bank that we've been working with that they were giving some priority to the nonprofit organizations that had less than the 500 or even less than 50 employees to try to get some of these PPP loans through, because they were trying to get keep them in place and keep them serving the community during these difficult times.
Yeah.
So.
Yeah, I think one thing that'd be good is to really let everyone know that this $300 charitable donation for individuals is available out there, so they know they'll get a benefit on their tax return. I'm sure there was a lot of disappointed people in 2018 when they got no benefit on their tax return. So
oh, absolutely, yeah. And I think the other part of it is for is saying that, and I think there's been some people out there, that some nonprofits that have taken a view of, you get your rebate check of your $1,200, $2,400 for a couple. If you're in a position to do that, redeploy that money through a nonprofit. I think there are a lot of people that are making an appeal for that. And because it's a non-taxable income item to you, you can pass it on to a charity. And even if you stand a deduction and don't get a deduction for it, it was money, pass it on. So I think there's a lot of nonprofits that are making that type of an appeal.
yeah, perfect. Well, thanks, Larry. I really appreciate it. So we're kind of getting to the end of the presentation here. We're hitting the end of the hour and a half, so I'm going to try to keep it short and sweet coming through here. Hanson-Weeble, we are grateful for the opportunity the Chamber has given us to actually present to you all. I hope you all found it informative. I'm sure there's a lot of questions we haven't answered, and I'm sure there's a lot of detail out there that has to come out from the government in order for us to give you concrete answers on this. Kind of the takeaways are, stay tuned for this. Be in contact with your CPAs or your bankers. I'm sure they're overwhelmed now trying to catch up to what the law is just as much as everyone else. So I believe everyone has our contact information. Please, in the chat function, if you'd like to sign up for our mailers, you can either go to our website, and in the bottom of all these items, you can send in here, you can put it in the chat function, you can send us an email, you can give it to the Chamber, and they will give it to us. So I really appreciate all the good work the team here has done. I want to thank Kim, Courtney, Shasta, Hannah, everyone, the Chamber, for putting this on. So thanks so much. And with that, I'll give it back to the Chamber.
Awesome. Thank you so much, Matt, and to the whole Hanson-Weeble team. We really appreciate you guys. It was a lot of information, and we are so thankful for experts like you all who can jump in here and give us the lowdown and answer questions. I think this was helpful for everyone. If you have questions that didn't get answered today, if you want to type them into the chat or even leave your email address, your virtual business card in the chat, we'll make sure that someone reaches out to help you with that. Otherwise, we will have this recording available in the next couple days. And then we also will email out the handouts. Kim posted them in the chat at the beginning. The 2 handouts that Hanson-Weeble provided. We'll make sure those are emailed out to each of you later this afternoon, along with their contact information. And again, you can always visit their website, hansonweeble.com. All this information is on there, so you can go back through it. And like Matt said, if you sign up for their email communications, they've been doing a fantastic job keeping things updated, sending out important information, and just staying in touch with what's going on, because there is so much to it. So we appreciate all of you so much for being here, for joining us. We know it was a long webinar and there was a lot of information, but we really, really hope it was helpful to you. We appreciate you. If there's anything we can do, please email us at info@augustava.com. And we look forward to seeing you guys again. Have a great rest of your day.
All right, take care. Thank you.
Bye.